So here's how you can pay yourself as a director of a limited company in the tax year coming up. Start with, you want to pay yourself a salary of £12,500. You want to use up your entire basic rate allowance. So the tax-free allowance that everyone gets, you want to pay that as your salary. That's going to trigger a small amount of employers' national insurance, assuming you're the only employee in your business. That then reduces your taxable profit in your limited company. So let's say you made 100 grand this year. You've paid yourself a salary of £12,500. That £12,500 is an expense to the business. So 100 grand income, 12.5 grand salary will trigger about a grand's worth of employers' national insurance, both of which are expenses to the business. You'll have corporation tax to pay of around £19,000. Now, what happens after that? So the rest of your income is made up of dividends. You don't have to wait until the end of the tax year. You can take your dividends throughout the year. So the most tax efficient salary to pay yourself in this scenario is like 50 grand a year. So £12,500 salary, 37.7k in dividends. In the current tax year, you'll pay income tax of about 3.2k. With the dividend rates going up from the 1st of April, you'll pay about 4 grand a year, leaving you with £46,000 net. So the company's paid around 19k corporation tax. You've paid about 4k income tax. You've also paid a grand's worth of employers' national insurance on a like-for-like basis. Because you've left money in the business, you've saved about £6,000 a year in tax, versus if you had just stayed as a sole trader. So the key thing to note here is the saving arises by you not taking all the money out of the business. If you take out all the money out of the business, you'll actually be worse off.